Now, I talked about this before with the indexes, S&P and NASDAQ. I use major quarter levels. So again, for traders they've asked about my sweet spot settings. Okay, so for my big picture hypothesis on these indexes, I just add a 0. Okay, I add a 0 on my sweet spots indicator. And we'll talk about going down to the 1 minute, which is basically subtracting a 0. But you'll notice, and I talked about this in previous videos, these indexes respect major quarter levels. I repeat, the indexes respect major quarter levels. Double zeros, 250 pip boxes, 500, and the previous day's highs and lows. So essentially you have an opportunity, and I'm only trading the US session on these pairs. But that means when I go down to a smaller time frame, so we look before the session even starts, before the US session even starts, I have a low of the day, which is just above the quarter level, and I have my major double zeros, triple zeros, whatever you want to call it, the 4,000 level, and I have the high of the London session and the high of the day. And for simplicity, I just typically draw the high of the day, the high of the session, prior to going into the window. That's it. Those are my 3 lines, and then I'm on day 1, day 2, day 3. Now you'll notice we had a very large move down, which coming back to looking back at the previous week, I mean, this was an absolute gift. If you want to learn something about day 1, day 2, day 3, the escalator and the elevator, I've had people message me and ask me about commitments of traders reports, the central bank, the interest rates, all that stuff. And I've repeated this. I don't care what anybody else says or what they think. I don't engage in any of that. I look at the charts. I have a thesis. I follow each pair. I have notes on those instruments. Day 1, day 2, day 3. Is it moving up or moving down? Obviously, I look at pairs that are moving up because I like to short things. Day 1 on the previous Monday. I'll just bring up my weekly separator. Day 1, day 2, day 3. And, this is 1,000 pip box. 1,000 pip box. So the market came down on the Monday and put in a low, and I said this before again, when they reverse on a Wednesday, you can still get a day 1, day 2, day 3. Wednesday forms the low. Thursday obviously is day 2 on the day count for the trade setup. Monday is always my first day. Everything starts on a Monday. So we go day 1, day 2, day 3. We're in 1,000 pip box. We had the massive move down, 2,000 pips almost, into the lower 1,000 pip box. Okay. And then we go day 1, and we have, this is first red day, by the way, was Friday, first red day. And then we have 3 levels of rise, 250, 500, and 750. We're in the 3rd level of rise at the previous day's high for the continuation trade short. And if you study L. Brooks, this is our H1 setup in a strong downward market. So we have a downward market where day 3, the market takes out instead of taking out the low of the day on day 3 and triggering day 3 shorts, we form 3 peaks coming back up into the open of the London window, and we have our high and our low rectangle in a 500 pip box. Okay, so when I come to the screen before the session opens, okay, so before we come into this hour before, it's very straightforward. I have peak formations up at 50. This is the S&P. And I've got peak formations down at 00, which form my low and high range. Now you'll notice how many levels. If these are peak formation highs and we look at our 00 boxes, so we have 100, 100, and 100. That's 3 levels of drop. But prior to our open of the session, the market moves up from our triple bottom formation below 50. This is before news, before ADP at 8:15 New York time. The market proceeds to climb 2 levels before coming back, continuing in that U.S. session window, and we proceed to auction up 3 levels of rise into the middle open of the middle hour for a 200 pip reversal off of the third level of rise into the peak formation of this trade. So for traders who are out there and they're going to post something, oh, this is hindsight and everything else, I want you to repeat after me. 1, 2, 3. 3 levels of rise, second hour, equity session, our micro M formation for the explosive move down through all these higher level longs. Now we have the stop hunt and then the New York Open reversing back up to the high of the day. So think about that. Equity market opens and goes up to the high of the day. That's a 15-minute move at the open of the New York session, the equity market open, back to the high of the day. So we've had opportunities at the open of that second hour. The market opens up, proceeds to auction back to the high, and now I want you to repeat after me again. 1 push, 2 pushes, 3 pushes at double zeros at the high of the day into the peak formations on the third level of rise for a reversal trend back down to the low of that middle hour. So again, whenever you notice two-sided price action, that's a creeping trend. The market could be coiling for a reversal. And for me, I'm not interested in trying to squeeze out every last pip. I'm going to take the money and get off the screen. Oil, same thing. We have our day one on Monday. So the market forms a great consolidation, a 100 pip box in Asia and in London. I'll put both these in for the day 2 trend trade in the US session. So again, peak formation low on Friday. Okay, peak formation low. Day 2, level 2 trend day. Day 3, high of the day, high of the week. Traders at the London Open have the opportunity to sell the high of the week in the London session. Okay, count the levels of rise. 100, 200, 300 pips, 3 levels of rise. Day 2, high of the day, high of the week. London for a massive short trade all the way back down to day 1, low of the week, low of Friday. So day 1, day 2, day 3, reversal high of the day, the 1, 2, 3 in the U.S. session. So for traders who have asked, what about continuations or in a market that's already broken down like that? Peak formation. I need a peak formation. This is a 100 pip peak formation. Stop hunt into the existing trend. Let's bring this back. Zoom in a bit for traders. We get the 1, 2, sideways 3. So just do the math. That's 1 hour up, beginning of the U.S. session. The reversal second hour, 3 levels up, double zeros, 25, 50, 75. Reversal, New York Open, continuation down. Okay, so you need to be looking at this. Who's caught? I'll tell you who's caught. Underneath this day 1. Day 1, they're going after the money. You've heard me say this over and over again. Peak formation low on day 2, creeping trend up, 100 pip box, 25 to 50 pips into, okay, start paying attention to where the peak formations are. Okay, peak formation, U.S. session on the way down. We get a peak formation into the lower level shorts, and then the continuation in the London session. So we've got our lower level shorts heading into the U.S. session down at the bottom of the week on day 3. They auction into the third level. So again, traders have said, well, we had 4 levels of drop. When the market has consolidation and it breaks down like that and we get a large volatility instrument, oil, gold indexes, it's all about the timing window. So we've come down 400 pips before the U.S. session opens with a large engulfment, and then 1 push, 2 pushes, 3 pushes into that peak formation low. For the long trade, after the news, back up towards traders. Again, study and understand who is in the money. If you start to see that, again, and then you're looking at what day it is, what level are we on, are we down low, are we up high, you can see who's in the money. Now, we got our shorts, the peak formation low. We're on day 3 at the low of the week, the low of the month. This is the last day of the month. And then 1 push, 2 push, 3 pushes as we head into the U.S. session after non-farm ADP. Not to say this is perfect, but there was a 100 pip explosive move that went vertical for the parabolic move into traders who were on the lower level shorts. So